How's it going, friends and family? My name is Amos, and not too long ago, I looked into the trade desk, ticker symbol TTD, and I even made a video about it. But after listening to their most recent earnings, they've got my attention, and I'm seriously contemplating opening up a position. What you see on your screen right now is their current stock price, $43. And you might be like, so what? If we zoom out 1 year, this is why it has my attention. They're practically at their 1 year low. I'm not exaggerating. About 12 months ago, they were trading for about $130 a share, currently $43. I mean, they just bounced up from $41.77, effectively the lowest price they've been in the past 1 year. And you might be like, okay, well, this is a falling knife. We zoom out and we look at their total stock market history, 1,450%. That is an absolutely crazy ROI. They became publicly traded September of 2016 in a span of about 9 years, 1,450%. Okay, so this is a compounder. It's just right now they're going through a tough time. Now, if you want to hear the full deep dive, then go and watch the original deep dive video that I made about them, because we go over the business overview and everything else in between. Because in this video, I'm going to be giving you an update to my thoughts and opinions surrounding the company. Because why would I say that I'm seriously contemplating opening up a position, right? So all that to say, I think both videos are worth the watch. The first one to get an introduction and to get familiar with the trade desk, and this one to see the recent developments. And I'm also going to be giving you a revised price forecast. Now, if that sounds good with you, let's go ahead and get into it. Now, on November the 6th, the trade desk reported their Q3 2025 financial performance, meaning for the past 90 days or 3 months, how did things go for them in their business operations? Here in Japan right now, it's November the 9th, so very recently. And the bottom line up front is that the trade desk beat on the top and bottom line expectations. So the earnings, another way of saying the bottom line, the profits. The expectation on Wall Street was about 20 cents per share. However, they reported 23 cents. Might not sound like a lot, but that is a good beat. Jump on over to the revenue. The revenue is also referred to as the top line, because when you look at an income statement, if you're an entrepreneur or a business owner, then you know the first line item is your gross sales, how much money your company brings in, the top line. The expectation was 719 million. The trade desk reported 739 million. And it gets better than that. Give me a second. Here are some highlights in the past 3 months, okay? The revenue, it went up 18% year over year. That was disgusting. That was a piece of cherry or spinach on my lip. They authorized $500 million of share buybacks to happen in the next week or up to the next year, whatever. And I'm not a gambling man, but I'm going to go ahead and make an educated guess that because their stock price is at their 1 year low, they're probably going to pull the trigger and start dollar cost averaging to bump it back up, because $43, it's pretty low for the trade desk. They also reported a 95% customer retention, meaning the ones that are buying advertisements through the trade desk's DSP platform, they're coming back and saying, we like it. We want to do it again. We want to run this campaign. We want to continue being your customer. And when you think about their balance sheet, right now they have $1.4 billion of cash and cash equivalents on hand, to that of $375 million of total debt. Friends and family, this is a company that is flush in cash, and their balance sheet is phenomenal. We'll be taking a closer look at their numbers here in a little bit. And when we consider their earnings per share, the profits per share, the bottom line per share, essentially, 21% growth year over year. And for their next earnings report, Q4 2025, they're proposing and they're projecting at least $840 million in revenue, which is going to be a 13% increase year over year. Because in Q4 2024, they posted $741 million. Now, if the trade desk said something like, oh, hey, next 3 months, we're thinking $750 million, I think the sell-off would be justified and warranted. But they're increasing that revenue by at least $100 million. So you tell me, man, this sell-off just seems absolutely crazy. Now, the downside is that, unfortunately, it does look like the growth in their numbers, it's slowing down. But I still think it's really great. Because remember, their revenue for the next quarter, 13% year over year. But when you take a look at their income statement historically, their revenue usually grows by like 40, 50, 60, a triple digit number percentage year over year. So it is slowing down, and I'll be elaborating on why that's happening here in a little bit. But before we get to that point, I wanted to share with you my updated price forecast for the trade desk now that we have more tangible numbers to work with. Now, the trade desk is a software company that basically sells advertisements on the open internet, including the streaming services and everywhere else, like those blogs that you visit to do that cooking recipe, the trade desk, right? And for them, I think it makes fundamental sense to assess their valuation predicated upon their free cash flow, because they're not really doing a lot of CapEx, and more importantly, they're a profitable company. So in this yellow row right here, I already went and filled in their free cash flow. The trailing 12 months, or the past 1 year, they generated $690 million of free cash flow. And the growth rate year over year, taking into account the past 6 years or so, is 16.7%. So in my model and calculation, I'm plugging in that their free cash flow will continue to grow at least 15% year over year. Then right now, the trade desk should be valued at about $47.20. So at $43, they're undervalued, but not by much. However, I do want to benchmark this calculation to another forecast, and it's the earnings, okay? I think the EPS is a good indicator of their growth story in the future, especially in relation to the PE ratio. Now, what's interesting about the trade desk is that when you take a look at their earnings per share of what they achieved so far in 2025, in Q1, the first 3 months of their fiscal calendar year, they generated 10 cents of profits per share. In Q2, it was 18 cents of profits per share. In Q3, this most recent quarter that they just reported, 23 cents of earnings per share. Now, the estimation that Wall Street is expecting for their 2025 full year is going to be $1.76. Now, in order to bridge that gap, that means in Q4, they're going to have to post $1.25 of earnings per share. I'm not going to lie to you, that's pretty steep, especially in relation to their past timeline and DNA and history. They've never posted $1 of profits per share. But historically, Q4, it does tend to be when their EPS gets bumped up higher and higher because of the holiday spending, right? You got Black Friday, Thanksgiving, Christmas, New Year's, all of the holidays. This is peak season. So advertisements and marketing campaigns are going to be through the roof. Let me just show you what I'm talking about. We'll be taking a closer look at the numbers here in a little bit, but I think it's important for you to take a look at this. Let me just zoom in and make the numbers a little bit bigger, so that way you don't have to pull out your reading glasses, right? So if we take a look at their earnings per share, Q4 2023, 20 cents. That was an increase of 36% year over year. If we do the same thing for Q4 2024, it was an increase of 79% year over year. So for Q4 of 2025, I also think they're going to be posting one of their better profits per share. It's just, man, it's going to be really, really big in comparison to what they usually post, because they usually generate like 4 pennies of profits per share, sometimes 11 cents per share, and it went as high as 36 cents per share. But we're talking about $1.25 of earnings per share. Earnings is basically right here, the net income, the bottom line. But having said that, I do think it might be achievable as long as they don't meet any speed bumps, their customer retention stays at 95, 96%, and the holiday season is bullish. Now, if Amazon is any indicator of how the economy is doing by the American consumerism capitalist society, we love buying random stuff to shove up our buttholes to get that free shipping of $35 on Amazon. It's what it is, okay? If that continues and the trade desk buys $500 million worth of their own stock in October, in November, in December, and it bumps up their stock price, but also artificially and financial engineering makes their EPS better, it could be $1.25. I'm not going to say it's not in the realm of possibilities, because if the amount of shares outstanding gets reduced by a significant amount, then the net income divided by the remaining shares outstanding, it's going to make it look better and prettier, okay? So when we take a look at 2025, we have about a month and a half to 2 months to go. If their trading multiple, their PE ratio is at a 30, this is a worst case scenario, by the way, because their 8-year average, the trade desk, they usually trade for 182. That's their average PE ratio. Sometimes it goes as high as like 250. Okay, so when you think about like Palantir, they're in that territory and ballpark. But because the growth in their numbers are starting to slow down and it's losing steam, between you and me, I do not think that the trade desk is going to be anywhere near a PE ratio of like a 150 or even a 120. Bull case scenario, I think the PE ratio could jump up to like a 55, but I think somewhere in between a 30 and a 55 for the PE ratio seems reasonable. So if they do not meet any more headwinds by the end of 2025, I don't think it's too crazy for the trade desk to bounce back up to at least 52.80. I think closer to like 55, maybe even $60 sounds reasonable. $96, I'll be honest with you, very unlikely. I do not see the trade desk hitting $96. Now, if you are a bag holder, you bought into the trade desk in 2022 or in 2021, and your average cost basis is like $150, I'm sorry, man. But it does get better, because if we fast forward throughout the years and we go ahead and assume that the trade desk is able to post $2.87 of earnings per share in the year 2028, and their PE ratio is about a 30. The S&P 500, the average PE ratio is a 31. So a 30 seems to be in line with the expectations of other big conglomerate, giant, blue chip household names. If the PE ratio is a 30, earnings per share is $2.87. The trade desk, $85.98 in a realistic bear case scenario. Now, if the script switches upside down and everyone becomes bullish around the trade desk once again, and their PE jumps up to like a 50, then 143 in about 3 years, possible. I'm not going to say it's statistically probable, because 143 for the trade desk seems really unlikely, okay? But let's go ahead and assume we're going to get really delusional here. And let's say their PE ratio jumps back up to their 8-year average. By the way, that number, 182, average PE ratio, I pulled that from Macro Trends. So hopefully their data is accurate. But if it jumps back up to 182 in 3 years from now, $521, do I see that happening? I'm going to be honest with you. No, I do not see that happening. Obviously it could, but realistically, if you're grounded in reality, like the earth is flat. No, it's not. Okay, the earth is round. 182 P ratio, not happening. But a 30 to a 50 in about 3 years from now seems plausible, right? So the trade desk at $43, if you look at it in a worst case scenario to a best case scenario, on paper, it does seem to be undervalued. Now, if the trade desk, for whatever reason, gets the same treatment that PayPal, Pfizer, XYZ, and some of these other fintech companies are getting, but they're in a different realm and territory, because the trade desk, they're essentially doing advertisements like Meta, Google, and Amazon DSP. But for whatever reason, if they're in that exact same territory of having a PE ratio of like a 15 or a 16 or a 17, just to show you what could happen, worst case scenario, right? If their PE ratio is a 17, then they could drop further. We're talking about $29.92 by the end of the year. Now, do I see that happening? Yes, but likely scenario? No. I think a PE ratio of a 30 seems more where the trends of their valuation should be, because their current PE ratio is a 48. Their forward trading multiple is a 21.8. You meet in the middle, about a 30, okay? So when we think about the compounder chart, where does the trade desk fall among their peers, the other companies that we covered on this channel in the past like 6 months or so? I'm going to keep them in the B tier. I think they're right next to Adobe, slightly better than Chipotle. Chipotle to me is like a C+. Adobe, I also think, is very high quality. They're posting very solid numbers, flush in cash, an excellent balance sheet. But Wall Street is also kind of fearful about Adobe. And some people are saying it's because AI is going to eat them up. AI is going to make them obsolete. And it's like, dude, Adobe's integrating AI in all of their features and software. Yes, that's a different argument about whether or not the customers of Adobe are satisfied. I feel like the retail customers probably not happy, right? But when you think about the enterprise corporate customers, the S&P 500 companies that are paying for Adobe products, especially the Adobe Acrobat, they're not going anywhere. But just like the Trade Desk, the Adobe is getting kind of like that stinky treatment. It's like, even though their numbers look phenomenal. So the Trade Desk, for me, I don't think I'm going to move them. I think I'm going to keep them in the B tier. I would rather go with the Trade Desk than Sezzle, the buy now and pay later fintech company. I would rather go with the Trade Desk than PayPal. I would go with the Trade Desk over Ford, Chime, and Carter's baby clothes. So let's talk about it. Why are their numbers slowing down? I'm a man of my word, and we're going to be doing a deep dive on the numbers here in a little bit, but let me just explain myself really quick. The fact of the matter is, I'm invested into Amazon, and Amazon is encroaching upon the Trade Desk's open internet territory. And as of right now, at the time of making this video, Amazon's advertising business segment, they're undercutting the Trade Desk. Meaning, Amazon right now, they're offering ad placements onto their platform, Kindle, Fire, Twitch, and Amazon.com for very, very low fees for businesses that want to do their marketing campaigns on Amazon. So all else being equal, if you have the option of going with the Trade Desk or Amazon, I think a business will choose to go with Amazon. Because think about it. If a company only has a limited budget for a marketing campaign, like you're rolling out something, a GTM for a new pair of shoes or a new smartwatch or whatever, the Amazon value add is the amount of data that they have about their shoppers and their spending habits. Because think about it. Someone like me, I've been shopping on Amazon since 2008. They know so much about me and my data. And that information is very valuable to a company who only has about 10 million or even 25 million for their marketing. That's a huge business incentive for potential advertisers to go with Amazon instead of the Trade Desk. Because why campaign on Peacock or Disney Plus, which are some of the modalities that the Trade Desk places their ads, when your ads might be better served on Amazon.com for a lower fee? So with the Trade Desk, you might be able to put your ads in front of about 100,000 eyeballs for the exact same price. On Amazon, you might be able to put it in front of about 200,000 eyeballs. Do you see where I'm trying to get at? So as a business incentive, that's why their growth story is slowing down. Because Amazon, they're coming out for them. But it is important to keep in mind that the Trade Desk, the ads are going to be placed on the open internet, meaning ads across different publishers, different websites, blogs, Roku, Disney, Paramount, Peacock, etc. Whereas Amazon, it's a walled garden. If you're buying ads through Amazon, it's going to be placed inside of Amazon's ecosystem. But it really doesn't matter that the Trade Desk and Amazon show their ads in different places because they compete for these same dollars. There's only a limited, finite pool of money in the advertising space, and you have to be wise about it. You might allocate 25% for YouTube ads, 25% for Facebook ads. You might even throw down like 5% to the Trade Desk for the open internet, and the rest might go to everyone else, including Amazon. Okay, my apologies. There was a pretty big earthquake here in Japan. By the way, there's literally like 6 to 15 earthquakes in Japan every single day. So even right now, my camera is shaking and vibrating. What's scary is Amazon's scale and ability to bleed while they take away market share from the Trade Desk. I think that's a very real threat. I'm not even going to lie to you. I was thinking about maybe downgrading the Trade Desk to being like a C+ or even onto the watch list, wait list because of that. Because Amazon, they can operate their ad business at a loss while they wait for the Trade Desk to die by 1,000 tiny cuts. Amazon has the time, the patience, and the capital to just crush and destroy the competition. And that's effectively what they've done with their retail competitors, right? Now, essentially, Amazon is synonymous with, I'm just going to order something on Amazon. Just like when you want to search something, you just say, Google it. Or when you get a paper cut, it's like get a Band-Aid. Shout out to Kenvue. So hearing all of that, you might be confused as to why I'm thinking about jumping in to the trade desk. Because friends and family, there's a catalyst that came their way at the end of October, and his name is Anders Mortensen. It almost sounds like the dude who played Aragorn in The Lord of the Rings, but he's going to be the new Chief Revenue Officer. And what makes this special is that Anders, he used to work at Google in the digital ads business. He was like a vice president or whatever his most recent title, which means he can implement fresh ideas into scaling the trade desk. So for me, I think the growth story is not over. I think the trade desk, there's a lot more to offer than you see right now. I think people underestimate the ability for a business enterprise to think long term. You think other companies are stupid to the fact that as of right now, they might be able to save money by buying their ads through Amazon. And in the future, if the trade desk gets eliminated, their ads are going to go 200, 300% increase in fees and prices, right? They're not stupid to that. Okay, if you're educated in business and you might be able to have a fun time right now, right? Like peeing in the dark. But 2 to 4 years from now, the cost benefits that you got with Amazon, it's going to disappear. And I'm saying that as an Amazon investor. So it would behoove of an S&P 500 company to not put all of their marbles into one nutsack, right? You want to be able to place a little bit of money here, a little bit of money there. That way, capitalism can do its thing and competition can keep the prices low and fair. And the trade desk, they offer that. I don't think that if you are a smart company, I don't think you're going to sacrifice the long-term horizon strategy and vision for just a short term of like, oh, we can save some pennies right now here. Because in the long term, you're going to be hurting. So I don't think the trade desk is going to disappear. So let's talk about my game plan, okay? And before we get to that point, man of my word, let's go over some of their numbers. When you take a look at the trade desk's top line, their revenue year over year, does this look like a company that is hideous, horrific, horrendous, disgusting, smelly, atrocious? No. Dude, year over year, it's just beautiful. It almost brings tears to my tiny little eyes. $2.7 billion of revenue in the past 12 months. Ever since 2017, the trade desk, they've been a profitable company. Yes, in 2022, it looks like they went in a downward trend, but they rebounded and now they're generating and they're printing cash. And speaking of cash, I think one of the best indicators of whether or not a company is actually generating cash is their free cash flow, right? Like what's the cash that's left over after funding for the operations to run the business? And the best way to do that is the free cash flow per share. What we want to see is a trend that is going up in the right direction. I guess we can start with 2015. Negative 25 cents of free cash flow per share. Now it's $1.38 of free cash flow per share. This is a pretty beautiful trend. If you want to just look at it in a macro level, in 2015, it was negative $41 million of free cash flow. Now it's $689 million of free cash flow. And that's why the board of directors and the leadership team, they authorized $500 million to be utilized to buy back their shares, because even they're realizing like, dude, our stock price right now is way too low. We jump on over to their balance sheet. As I alluded to earlier, they have $1.4 billion of cash and cash equivalents on hand. To that, of their total debt, this includes the short-term and the long-term loan obligations, $375 million. So after you pay off all the loans that are on the books, the trade desk has $1 billion of cash left over. $1 billion of cash. And if we take a look at their debt to EBITDA ratio, which essentially EBITDA is their core operating profit, how long would it take for the trade desk to pay off all of the loans on the books through their own operations of what they're generating? 0.53, meaning it would take half a year for the trade desk to pay off all of the loans on the books and to be debt-free, to be financial independence, retire early. I think their debt to EBITDA ratio, phenomenal. Free cash flow per share trend, phenomenal. Earnings per share trend, phenomenal. And if we take a look at their ROIC, which is the return on invested capital, the golden standard is at least 10%, and the trade desk has 11.1%. It looks like it went in the wrong direction for the longest time, going from 36% down to the low of 3% in 2022, but it's slowly going back up in the right trend, and it's 11%. And is the company buying back shares? Yes, they're buying back shares, and they're going to buy back a lot more. In December 2024, there was 500 million shares outstanding, and now there's 499 million shares, and they're going to be buying back the shares more aggressively. So when we think about the trade desk, do I believe that it's the best deal out here in the stock market? No. But is it one of the better deals? Yes. I'm not going to say it's the best, but it's not a bad deal. And I do want to call this out, okay? I know in our calculation, we saw that they should be like $47 or even like $53, $57 a share. Just because a company's inherent worth should be that much, it doesn't mean that it's going to reach that price. For all we know, the trade desk, they could continue dropping like a rock and go to like $20 a share, $15 a share. Yes, that could happen. However, I think when it comes to the trade desk, I am going to play with this one. I'm willing to get a really expensive learning lesson out of it if things go south. Now, if you want to know what price I'm going to be buying into it, I posted it on the Patreon. I think when it comes to the trade desk, I'm only going to be throwing fun money at it. Nothing I'm not willing to lose. Like, it's not my biggest conviction. My biggest conviction, as you saw by the compounder chart, was Amazon and Google. Unfortunately for me, I already sold out of Google, made a good profit, and I said, okay, I'm out of here. But with Amazon, that's where my next ship is at. Other than that, I wanted to give a huge shout out to Ray for helping us out with the Amazon Baby Fund. I wanted to let you know that that money is going to be utilized and is appreciated because we've been trying to do the whole cloth diapering thing, but it's just not going to happen for the time being because our hands are full and we're first-time parents and everything. So we've been buying disposable one-time usage preemie and newborn diapers because she poops and pees like 12 or 15 times a day. I'm not exaggerating. After every single feed, she poops and pees. You change it. About a minute later, she urinates and drops protein bars once again. So it's just one of those things where it's like, if you want to do cloth diapering, I'm going to run out of fabric, right? So that's why we're doing the whole disposable route as of right now. So for you Kimberly-Clark investors, and also we can throw in the Procter & Gamble, Huggies, and Pampers, we've been buying that brand of diapers. We're not going to go with the generic ones. We're not going to mess around with, up-and-coming ones. We're just going to go with the tried and true. I ain't trying to deal with any more blowouts. I dealt with one blowout already. It was disgusting beyond belief. Like, I'm talking about baby doo-doo all over her back, all over her thighs, and I kept thinking, how can something so small, this little potato, continue to poop all over herself? It's quite a visual to see. And yes, I don't think I mentioned it before, but she's really freaking small. She's in the bottom third percentile for her age bracket and gender. She's really small, and that's why we've been buying the preemie diapers. But finally, we're moving up to the newborn diapers, and that's fitting her a little bit better. So all that to say, thank you so much, Ray. And for everyone else that made it to the end of the video, just let me know. What do you think about the trade desk? Are you invested into them? What am I missing? Do you hate them? Let me know before I jump in. Anyways, I love you guys. Stay safe, good luck in the stock market, and I'll talk to you really soon.